Guys, what's going on? Yes, so my name is Maya Lee. I'm excited to join the Freedom family here. So I met Beach Trader and we started talking about both what we were doing. I actually loved all the stuff that you guys were doing here in the trading group with the nonprofit, and that's everything I do. So just real quick to tell you guys about who I am. I am here in Atlanta, Georgia, but I am from Memphis. I'm from Nashville, Tennessee. I grew up in Nashville there. I have four kids. One of my daughters has special needs. She has autism. So doing work for special needs children, any of those causes is dear to my heart. So with coming up, I was actually raised in Nashville. I was raised by my grandma because my mom was murdered when I was a little girl. So her her murder was like one of the number one unsolved murders to this day in Nashville, and that how I was raised by my grandma. So she just was like a little old lady, trying to figure it out, and she didn't know much about financial literacy, of course. So, it was just passed down in her family, just what she knew, and she was doing her best to try to raise us. And then she passed away, unfortunately, when I was 17. And then kind of a hard lesson at 17, kind of having to learn how the system worked. And then understanding at that time, my grandma, we thought she had was life insurance, and she actually only had a term policy that didn't really cover her in burial. So here we are. When my mom was murdered, I had a brother and a sister. My grandma was raising us. I was 17. My brother was 13. My sister was 12. And we were kind of just left to figure out who was going to raise us, what was going to be done. And then with my grandmother's estate, she didn't actually adopt us as we were kids. She was just a legal guardian. And to her knowledge, I'm pretty sure she thought that her just taking legal guardianship of us would allow us to take over her things when she died, but that wasn't the case. So I tell a lot of people, which we can talk about this more. I'm going to stay on subject with life insurance, but get it into your estate when you pass away, because you can have a lot of businesses and have a lot of money, but then if there is a issue where it comes up with and probate, and it can come with your family is even able to access your money and your things, which would happen to my grandmother. And so we were just left with what we had. I was 17 years old, and fortunately, I had a scholarship to go to school to be an engineer, and I was able to get good jobs, go to good schools. And with that, working for the government and other people, I still just working hours and hours, not able to have time with my kids. I had a daughter with special needs, so that was finding special care. So I'm working hours, working crazy, still not enough money. And I decided to step out on faith and be an entrepreneur. And I've been an entrepreneur for about 6 years. And within that journey, I come across helping a lot of families. I found people like myself. I didn't know nothing about money, even up until a few years ago. I didn't even have life insurance. Knowing that my mother died, knowing that my grandmother died, it still just didn't dawn on me to get life insurance. It still didn't dawn on me to handle all of my affairs right, even though I had three little girls. It wasn't until like I got more into business, I met other business people, and they put me in the financial industry. And I was like, look, I need to cover my life. So we're talking to you guys about that, and that's my story. I like to I help any family, but with women, my passion is with helping women, especially with situations like my mother, because my mother, the number one suspect in her death for a longest time was my father. So that just give you a background. So I'm very passionate with domestic violence and families and help, especially helping young women, because where I come from, it's like it's when people see me and now and I have nice things and I look nice, they judge me, but they don't know I worked hard for everything I got. I'm from the hood, and where I'm from, people don't have nothing. So I like to help young women understand that they don't have to choose a certain path, but just because they see it on TV, they can go another path. So I like to help them understand that they become entrepreneurs, understand about living in America, and we have the best opportunities here. A lot of times where we talk about there's immigrants a lot of times come to America, and they're the number one people to start on businesses and become entrepreneurs because they have no choice, and then their businesses become successful. And unfortunately, in like the American home, entrepreneurship, owning a business is not taught. Most Black and brown people do not even know where to start to own a business, do anything, or even to properly set up themselves after they pass away. So I'm just going to talk to you guys a little bit about what I do here on this graph. It's just in this presentation. It's just for you guys to follow along to what I'm saying. So, you know, we have two sides in America, right? We have what we want to call a green side and a red side, just like, you know, in the stock market, green is good, red is bad, up and down, right? So the green side of America are Americans who make $100,000 or more, right? These Americans are usually, you know, making more than $100,000. They own land, they own homes, they own properties. They're able to invest in stocks, invest in real estate. Okay, they understand about life insurance and different methods to protect themselves. And then you have the red side, which is the 95% of America. So really, the green side represents 5% of America, and the red side is 95% of Americans, and which is most people we know. You know what I'm saying? Most of us now who are trying to come up and make it in the game. You know what I'm saying? So 95% of Americans make less than $100,000 a year. They're living paycheck to paycheck. They don't own properties. They're trying to buy a home. They're most likely paying rent to the people on the green side, right? They don't understand investments. They don't understand life insurance, and they don't understand retirement. Okay, so most of the times people are dependent on Social Security to retire, and most people don't understand probably in about 15 years, maybe even less than that, we will be out of Social Security money. So there will be no Social Security for people to even draw to retire. And then, you know, they're usually taught maybe depend on 401ks or put, you know, oh, if you work hard and put a lot of money in a bank, maybe you'll be able to retire. But that's why you go to Walmart and see everybody, grandma and grandpa, in there waving. It's like it was a little old lady who could barely hand me my receipt back the other day. And I was like, somebody, grandma should be at home cooking, making cookies, but she's in here working because grandma can't afford to pay her bills with her Social Security check. Okay, so that's the reality of things, that will be you if you're not understanding about retirement. And then that will be your family not being able to bury you when you pass away. And then you're leaving generational debt. So 4 things you want your money to do, okay, is you want your money to be safe. You want your money to grow. Of course, you want your money to be accessible. And if you want to avoid Uncle Sam as much as possible. So we want to avoid taxes, right? Because who wants to give them 30%, 50%, any percentage of your money, okay? So there's homes of money. The 3 homes of money I'm gonna talk to y'all about today is a fixed home of money, a variable home of money, and the index home of money. If any of you guys ever heard of this is places that you put your money, hoping that it'll grow for you, hoping that it'll be safe and it'll be accessible. And if you can, in these accounts, avoid taxes, of course. So the first home of money is a fixed account, which is a bank account, anything to do with a bank type of situation. Okay, so a bank account is going to be a fixed account, which means that's going to be a safe account. Of course, it's going to be accessible at all times to you because it's your bank. But the downside to a bank account is you do have fees and you have a very low interest rate. So has anybody on the call ever heard of the rule of 72?
Yes.
No.
Yes and no. Well, just I'm gonna tell you guys what it is. So the rule of 72 is a rule by Albert Einstein, which tells you if you take 72 and you divide it by your interest rate, that'll give you the number of years it takes your money to grow. So that means your dollar into 2, your 10, your 5 into 10, your 20 into 40. Okay. So most banks from credit unions sometimes give you a little better interest rate, sometimes 0.5%, but most banks, which are Wells Fargo, your Bank of America, they're going to give you a 0.03% interest rate, okay? And if you take that and you divide that by 72, that gives you 2,400 years. So that's the 2,400 years is going to take your dollar to turn into $2 at the bank. So when you have a bunch of money sitting in the bank, it's not really growing for you. And then everybody knows what the bank does with your money, right? They take your money and they invest it for you. So that's why when you go to the bank and you put $100,000 in there, and the next day you go and say, "Hey, I want to take all my money out," they're like, "Well, why, Mr. and Miss? Why do you want to take your money out of the bank? Because we're using your money right now. We need you to keep your money here so we can keep using your money." So they will really try to talk you out of taking all your money out of the bank because they are using your money to invest it for them and make money. And if you look into what banks are investing in, banks are investing into insurance. Okay. Insurance is the number one recession-free industry. Okay, last year during COVID, they made billions, okay, multi-billions of dollars. They spend billions of dollars on advertising every year and don't blink an eye because they know they're going to make billions more off of people from insurance. Okay, and there's so many different types of insurance, so it's very much important that you understand why life insurance is important, because if you're going to have insurance on your car, you're going to have insurance on your phone, your house, even your jewelry, even at the bank, right? The FDIC, what do? They insure your money up to 150,000. But if you have $1 million in there and the bank goes belly up and you go to the bank and say, "Well, hey, I need my million," well, they're going to say, "Here's 150,000 because we don't know what the heck happened to your $1 million. We're done. We're closed." Okay. So that's very much understanding the importance of getting life insurance on your life and understand these different homes of money. So when you move to from a fixed home of money, the next home of money where you can actually grow your money more is a variable home of money. So this is going to be a high reward, high risk account. So very much like we're doing now, stock brokerage accounts, 401ks, 401(k)s, your 403bs, your IRA accounts, your Roth IRA accounts. Any type of account that's invested into the stock market is going to be a high risk account with a high reward. So we see that hand on hand here with investing, right? And that's why I actually joined the family, because I'm like, if I'm teaching people about money, I'm teaching them about investing, I have to know the full spectrum of this thing. I can't not understand actually how to make money in the stock market, because I know how 401ks and things like that work for my clients and how it can grow their money. But can I grow money myself in the stock market? And that's why I challenge myself with this group and learning with this family. So with understanding that, right, we can see that any moment we can lose our money in the stock market. So just for example, the 2008 stock market crash, right, where the housing market crashed. I'm in the housing market. I was an engineer, a young engineer. I had a job with the government. It was sending me back and forth to Puerto Rico. We was doing all type of different things. That time I had an internship. I had to quit, and I had to do different type of hustles until I got back into the construction game, and we was able to flip it, and things started back eating again in the construction game. So it took a really big hit in the real estate market then, but also the whole market, also in Y2K, right? They also seen that. So at any point, and also at September 2011, people woke up the morning before, their 401ks were fine. The next morning they woke up, of course, somebody drove a plane into the buildings and the stock market crashed. People lost their whole life savings in a matter of minutes. So that's what can happen in a variable account. And that's very important to understand, especially with your retirement. So, we were normally taught, like in the system, quote unquote, work 30 years and put your money in a 401k or a pension plan. But back in the day, they did pension plans. Okay. And so they kind of gotten out of that and pushed people into 401ks, into the IRAs. And so, yes, it can get you a high reward, but you have to have in a retirement account, you need to understand, you need to have a good portfolio. You need to have more than one retirement option just in case one can crash. You don't want to retire and then only depend on one thing to retire, and then or even underestimate the amount you need to retire. Because a lot of people say, I want to retire. And oh, how much do you have? And it's $100,000. But if you take 100,000, if you spend 10,000 in a month, that's your money's gone in a year. So then you have to, take your spending, take your habits down and learn actually how to live off your retirement money. Even if you take $1 million and your lifestyle is $100,000 a year lifestyle, you're going to run out of money in 10 years in retirement. And then you're going to be that grandma and grandpa in Walmart, in Kroger, putting it in bags and saying hello at the door because they did not understand to actually save and then put their money in retirement plans, especially tax-free retirement plans. So understanding the only retirement plan that's not tax-free is a Roth IRA, is an IRA account. Those are tax-free, but with those accounts, you still have the variable. So you still have the up and down with those. So you can take those accounts and roll them over into something that'll give you a little bit more protection. And that's where we come into what we call hybrid account, which is an index account. So if anybody's ever heard of index accounts give you a safety of the bank. So they have no risk and they're going to give you portion kind of like a variable account because this is invested into the S&P 500. So you're going to get a portion of your market upside. So with what that means is with this account, okay, you gain money, but they're going to protect your money in what we call a nice little money, a bubble called an index bubble. So that index bubble, right? Why do they protect your money in the index bubble? So if you look at this graph, you see we have a client, and this is a real account. He had two different accounts. So the red line is a 401k account. The blue line is an index account. Okay, so in an index account, the bank, when you have your money in the index account, you give them a little percentage of your profit. Okay, so they protect your money. So let's say, for example, they give you a market cap of 15% and the market goes up 20%, where they're going to give you 15 and they're going to keep 5. And because they kept 5, now you have an index account with an index bubble, and that's going to lock your money in a bubble when the market falls. So when the market falls down, you don't lose your money. And that's what here's showing you on the graph. So both of these accounts started with $100,000, right, in 1998. So of course, the variable account seen a higher rate of growth because when the index account is growing, you're giving away a little bit of your profit, but it's protecting your money. So when the market crashed in Y2K in the year 2000, crazy, you seen the big crazy loss in the variable account, almost 30%. Whereas in the index account, you have that nice blue line. That blue line stayed the same. What does that mean? That means you didn't gain any money, but you didn't really lose any money. But anytime the market went up a little bit, you gained a little bit. So that doesn't mean every day you didn't make any money. Just when the stock market fell, that's why the bubbles are like exactly in one line. They're a little uneven because any day the market would have been great. You would have made a little bit of money that day, but anytime it drops, then your money's locked in that bubble again and it's tight and it's not popping. Okay. It said like the variable account, you got that bubble popped and the money's dropped all the way down. So then of course, now with that steady growth in index account, it's actually outgrowing the 401k account now. So if you look at the graph, it's trying to catch up. Even in 2008, when the market fell again, the variable account seen significant losses, while the index account actually didn't see any loss. The money stayed the same. And towards the end, when he took money out of both of the accounts in 2013, you will see the difference in the profit. So in the 401k account, he only seen a $50,000 profit, whereas in the index account, he's seen $100,000 profit. So with those two different accounts, you can see sometimes people are like, oh, I don't want to give them a percentage. Like it's just like having a little piece of pie. Like every time you just give them some of the crust. You're not even giving them a whole slice. You're just giving them a little crust. Like, please don't, let my stuff go bad. Just here a little piece of crust. Instead, in the variable account, you're just taking the whole pot, but you're also taking the losses that come with that. So no one is protecting you in versus the index account where you have some market protection. So that's very important to understand. Normally, it's about $10,000, okay, to start an index account. If you don't have $10,000, you can start it with $5,000, but you only have a 1 year to fund that account up to 10,000, okay? This is a very smart account to have for retirement because this account also is the only other account that's tax free, and it's the only account that I can guarantee you won't experience market loss. Okay. Any other account, I cannot tell you. I can't guarantee you in a 401k, I can't give, but in an index account, especially an index annuity, we can guarantee you your money. So with that being said, there's a great thing that what happened in the insurance industry is they actually took index accounts and they combined them with life insurance policies. So it took down the amount that you could start the index account with. So before I move on to the next part, does anybody have any questions about the 3 different homes of money? Okay. So next, after we go into the 3 different homes of money, and before I explain to you how you can mix an index account and a life insurance policy together, I'm going to tell you about the different types of life insurance policy, okay, and why you should have a life insurance policy. So you should have a life insurance policy, definitely if you're the head of your household, if you have children, if you just bought a home, if you just had a baby, if you have grandchildren, if you want to leave any type of legacy behind, if you are a business owner and you want to keep your business running, if and a lot of times with people, they're afraid to leave money to the family, and that's where you can actually leave the beneficiary to your life insurance policy as a trust, and then the trust can allocate what you want to done with your funds. So a lot of people don't know that you don't have to leave a person as your beneficiary necessarily. You can leave that as a trust, and in that way, in a trust, you actually have a little bit more tax-free and tax benefits. So that's something we could talk about later. But it's just something to think about and marinate, especially with all of us who are building financial freedom here. That's why we're all here. We're all here because we're chasing something more. I have my why is my 4 children every day, especially my daughter with autism. My biggest fear is that she outlives me, right? And if she outlives me, who is going to take care of her? And we, to be honest, no one gives a fuck about kids, and not especially that's not their kids, especially special needs kids, because I see it every day, and I see even their own parents abusing special needs children. So that's my number one concern when I'm fighting for my children. And so when you're thinking about why should I have life insurance, what is your why, and what are we all here for, building financial freedom for, then that's why you should have life insurance, because you're building something more, especially you want to be a millionaire and all of them, you want to make I want to make $100,000 in 90 days. So I need to have the proper type of life insurance for me and legacy, just in case even if I do pass away early, like my mom, like my grandma, I'm able to leave something behind. So when thinking about life insurance, okay, you want to think about the type of life insurance that you can get. We have 3 different types. You have a term policy, and a term policy is your policies that give you the greatest amount of coverage in the shortest amount of time. So they're going to come in increments. So 10, 20, sometimes they give you 15 years. So 10, 15, 20, 25, 30. I've seen 35-year policies sometimes. But the thing to understand about a term policy is they do expire. So if you don't pass away within this time limit, that policy is done. So my grandma had a 20-year policy, and she passed away after that 20 years. And no one ever explained to her. That's why, especially in the community, we have a very skepticism about, my grandma had life insurance but didn't pay her, because they weren't actually explained what life insurance is. So my whole goal was I sit down with people is the education. I don't want to push a policy or any type of thing on you. I just want to make you think and open your mind because I don't charge people for what I do. The companies pay me. I'm not worried about what people can pay me. So everything for education is for free. And that's what our parents and our grandparents did not get. They were actually charged for this education and did not understand. It wasn't broken down. So understanding that term policies do expire, but they are great, okay, for different reasons because you can actually have multiple policies, okay? So I have multiple policies. A term policy can be used for mortgage protection. Say if you buy a house recently or you want to buy a house and the house just costs 300,000, well, you can get a term policy and 300,000 for yourself and use that, allocate that term policy to pay off the house, okay? And then you can have another term policy, multiple term policy because you have multiple kids and you can't afford a whole life policy. And so they're very affordable, they're cheap. So sometimes, for like a 30-year-old, for example, you can get a $250,000 policy for like $20, really cheap. Sometimes for older people is more, right? With insurance, they look at health, age, and then your driving record, your background check, your credit. So a lot of that times goes into play. And a lot of people, when they do it when they're older, they have a little bit higher rating, and it's because of that. Okay. So of course you want to think about, for if you have any grandchildren, you have any children, locking in their policies before they have any health problems. So a term policy is great too. Even if you are older, you're in your 50s and you just want to get something, you can get a 20-year policy. Okay. And you're like, hey, I have something for 20 years. It's $1 million. Doc told us about a story where someone had a policy, they had $1 million policy, and they was able to put it into something I'm gonna tell you guys about in just a second, but it changed their family, a whole generation, just off leaving a policy. Okay. So you can have a term policy. If that's all you can afford at the moment, I tell people that's fine. Start with a term policy and then work it out to a whole life policy. And sometimes 30 years is all you need. And some people like, hey, I'm in my 50s. I don't think I'm gonna live past my 80s. Because actually in life insurance, we do studies. And right now, the average American isn't living past 85. Okay. So in even sometimes younger than that, but 85 is the longest, like the average age. So, if you're about 50 and you're like, look, I just want a 30-year policy, something simple, you can get that. And you can get multiple ones to cover different reasons. Also, when people, when they pass away, don't think about debt that they're leaving to their family. Like literally, that generational curses, that debt is the same thing. You leave your debt, you pass it down to your kids. They credit isn't good. I mean, I was the product of that. I didn't understand shit about money, about anything. I probably ran through $100,000 and didn't know what I was doing. I just a young girl. I'm from the hood. I'm like just buying up shit, not understanding. Hey, put some of this money away for a rainy day. And I did see a rainy day, and I was messed up. And I was just like, I just had a whole bunch of money. So a lot, and that's in our community. We just not taught, right, what to do with money. Okay. So especially helping your family understand too, like, hey, if I pass away and you do get a lot of money, please open a business. You can tell them what to do. You can leave the money to the trust, and the trust will allocate the money in the ways that you want. So that's one thing I say a lot, because that's what I'm doing for my special needs daughter. If she outlives me, if I pass away before her money is left in a trust that will take care of her for the rest of her life. Okay, so a term policy is great to have. It's very affordable, super cheap. You just need to understand that it expires. A great example of term policy is the policy you have on your car. A car insurance is a term policy. You only get that for 6 months to a year. So when you think, it's funny thing about car insurance is that it's mandatory, actually federal mandatory to have car insurance on every state on your car, right? But it's crazy that it's not mandatory to have life insurance on the life drive in the car. So if you get in a wreck and die, your car is covered. But if you don't have life insurance, you're not covered. And the car insurance industry show ain't paying for your funeral, so you better do a GoFundMe. Okay, so it's really a joke in the life insurance industry. It's like, if it's people understood that life insurance, what life insurance really meant, it would actually be, they, if they only wanted to use it for death, it would be called death insurance. It's called life insurance for a reason, because you can use life insurance while you're alive. So it's really like jokes on you, because y'all don't even know. Okay, only the wealthy, only the people under the top people understand that they're leveraging life insurance policies. So you can do this with different type of policy, especially a term policy, okay, as well. Also, we have a second type of policy, which is ROP, which is a return of premium. This is also a term policy. So just as it sounds, return of premium, with this policy, this means you get your premiums back that you pay into the policy. Okay, so this isn't like an investment account or anything. It's just strictly your premium. So say if you pay $100 a month for 12 months, that's $1,200 for a year. You do that for 30 years, there's $36,000. Okay. So at the end of the ROP policy, if you don't pass away, you'll get $36,000 back. It beats not getting anything back. Let me state, in a regular term policy, you don't get any money back, only the money if you die. Okay. The only thing that's also great about a term policy, okay, is you can get one and it can come with living benefits. So right now in the life insurance industry, there's something called living benefits. A lot of the bigger companies, I'm surprised, haven't jumped on to living benefits as much. They may have one or two. They have something called accidental death, which will double your life insurance. It pay out if you get into an accidental death. Okay. But a lot of people, when I look into their policy, I just looked into a lady's policy, and she said, oh, I had 300,000, but she actually only had $150,000 policy, and she would get 300,000 if the husband died an accidental death. So a lot of times people have to read the fine print with your agent. So the difference with me is that I'm not a life insurance agent. I'm an independent broker. So what an independent broker allows me to do is look at multiple companies and actually be real with my client. I'm not here to look out for the life insurance industry. I'm here to look out for the clients, okay? Because insurance makes money, okay? So with certain agents, they upsell because they need to make money for the company, okay? So they'll lock a lot of people into policies, high premiums, not really telling them what they're paying for. Okay, so you want to get a policy with living benefits. So living benefits will cover you if you live too long, you die too soon, you become sick, ill, disabled. Okay, so there's 4 living benefits. There's chronic illness, there's critical illness, there's critical injury, and there's terminal illness. With these 4, okay, living benefits, it covers up to 30 different things that can happen to you, even stroke, heart attack, diabetes, you get cancer, anything that you can't perform 2 out of 6 daily living activities. And daily living activities are bathing, eating, walking, transferring yourself back and forth. Okay, if you can't perform 2 out of 6 daily living activities, you can actually get paid up to 95% of your policy while you are alive. Okay, so you don't have to die to get the money. You can get paid out. So this is the great thing about having multiple policies. So say, for example, you do get an illness, you do get a qualified illness, okay? And a qualified illness says that you can get your policy paid out, but now you got 3 policies. Well, you can get one of those policies accelerated to you while you actually keep the other 2 policies. So if you survive actually your critical illness, your chronic illness, right, you can keep the other policy until you pass away, actually. Because once you get a chronic illness, once you get a bad, and it's actually harder to get life insurance. So we have life insurance for those policies for that. Like say if you aren't able to get covered, there's something called expense, and that's literally what it's called. It's only about $25,000, and it will only cover your burial expenses. Okay, it is not a generational wealth building. It won't pay for debt. It won't do any of those things for your family. It will just bury you. Okay. And unfortunately, a lot of times people wait to get life insurance and they have a lot of health problems. And that's the only type of policy that I can get them unless they can invest into an annuity. So I'm going to tell you guys about that really quick here in a second. Okay. So the term policy and the ROP, both are term policies. The ROP comes in 15 to 30 years. Same thing, except for the regular term. You're not going to get money back. You're just going to be covered for 10 to 30 years. And the return of premium, you'll get only your premiums back. But both of these policies have living benefits. Both of them are very affordable. They do both expire. So I have a term policy, 30-year for myself. Okay, it's going to cover me well into my 60s. So I was fine with getting that policy. If something happens to me, I'm going to cash out my term. And I also have a whole life policy. Okay, so my whole life policy will cover me for the rest of my life. So I won't have to reapply for insurance or worry about that for my family. All right. So the third type of policy, all right, is a permanent policy, whole life policy. The best type of policies in this category, okay, are index universal life policies, okay? But with whole life policies, you got a couple different kinds. You got guaranteed universal life, you got variable universal life. So a variable universal life is going to be a policy, of course, it's going to be variable up and down with the market. Okay, you got guaranteed universal life. That's a little bit something for older people. Okay, you got whole life, regular whole life policies. Those are policies with cash value, but usually with those, you really don't have an investment account. You just kind of have a cash value with the policy. Sometimes with those policies, you either choose the cash value or the death benefit. You don't get both. Okay, and then you have policies that do have the option of taking out the cash value and the death benefit. One of those policies is called an index universal life policy. So this ties in earlier where I told you guys about the index account, right? So remember what I told you about the index account. This is an account that's invested into the S&P 500. It's going to give you the safety of the bank, so no risk, all right, but it's going to give you portion of the market. So you're going to be able to make money in this account. Your money's not going to be sitting at 0.3%. It's going to actually be growing 6 to 12% every year. Okay. So we know how much that can actually grow your money. So a permanent universal index life policy, a policy that's going to go your whole entire life. These policies can be used for children because they grow a cash value. So this policy has three components. It has a cash value, it has a death benefit, and it also has living benefits. So the cash value is sort of like a savings account, but instead of a regular savings account in the fixed bank, this is an index account that's growing 0 to 12%. Why do we say zero? Because zero is your floor. And when the market falls below zero, you don't lose no money. When the market grows the top percent, the most I've seen is 15%, okay, being accredited. Okay, so when the market grows up, you're gaining money. When it goes down, it's keeping your money safe. So you have a cash value that's being invested into an index account. Also, separate from that, you have a death benefit, and then you have those living benefits. So let's say, for example, you have $100,000 IUL. For that IUL account, you're paying $100 a month. Because you have two components in this account, that $100 is actually being split. So $50 is going to go into your index account, okay? The other $50 is going towards your death benefit. So now, with that, every month, that's $1,200 a year. Now, every year, you're actually only paying $600 towards your policy and $600 into your investment account, okay? And with that investment account growing 0 to 12% every year, you now have an account that's growing money instead of just sitting there. And then something great you can do with the index account is you can overfund the index account. So say, for example, you have the payment of $100, but now this month you have $200. Now you take that $200 pay it into your index account. Well, you remember $50 goes into your investment account. So now that extra 100, you're putting $150 into your investment account. So that means more money is even growing. When you pull the cash value out of this account, remember, it's tax free. We tell people let this account grow at least 10 years, but you can pull the money out before then, okay? You can take it out as a withdrawal or a loan. This is where this becomes infinite banking. You become your own bank. So when people say loan, what does that mean? That means you loan money from yourself, okay? So you loan yourself money. So let's say, for example, you have $100,000 in a death benefit, and your your cash value can outgrow your death benefit. So now you have $250,000 in the cash value, but you need to take out 20,000. So they're going to ask you, do you want to withdraw or take a loan? Okay, when you take a loan, that means you're going to take 20,000 and say, I'm going to pay 20,000 back to myself. Okay. And they're going to keep growing your account like that 250 is in there. But if you take a withdrawal, you're now understanding you only have 230,000 in there because you took 20,000 out, and you're only 230 is growing, if that makes sense to everyone. So even if you do take a loan, you're only paying it back at 3%, 4% at the most to yourself. So it's not like you're paying it back to the bank, you're paying it back to yourself. And this is where you leverage the most from your money. Okay. The wealthy a lot of times put money into index accounts, specifically index universal life policies. McDonald's, JC Penney's, Walt Disney World are some of the couple of the companies that have used, okay, life insurance policies to leverage for their companies and take out loans, actually grow their companies bigger. Okay, so you can use life insurance policies for your children for college, okay, for them seed money as they grow older, want to buy a house, start a business. And you got to remember, if you leave 250,000 for them, that's $250,000 tax free. And then if you leave it in a trust fund, that's when you're making trust fund babies. Okay, so that's the whole goal. My goal is to set 1,000 families free, 1,000 families free from a job, especially 1,000 mothers. Okay, we want to make 1,000 millionaires. So that'll put $1 billion back into the Black and brown community. Okay, so that's what we want to do. And especially specifically, you want to think about using life insurance. This is what the wealthy are doing. They're putting $2 and $3 million into a policy, letting it grow, then pulling it back out tax free by IRS code 7702. Okay, so that's something important to think about when getting an index policy, or think about if you're a little older, you could think about using the money for retirement if you don't have a retirement plan. Something that also with the index account is called an index annuity. That's the story I was going to tell you about. So an index annuity is an account that protects your money if you live too long. So it actually protects your money and gives you a lifelong income. Okay, so say for example, when Doc he was telling us a story, it was a young man, he had $1 million and he put into what we call index annuity. What that did is gave him a $10,000 a month income. Okay, now he was able to leverage that money, leverage that income, and go to the bank and take out a bigger loan for even $2 million, take out go buy property, go buy real estate. And he was able to grow, double his money, pay back his loan, and now a multi-millionaire just because his father left him a policy, right, with $1 million in it, and he was able to take it into an index annuity. So an index annuity, you can start one of those for the minimum is 5,000. Like I said before, you can fund that account up to 10,000 in 1 year. Otherwise, the minimum is $10,000. Okay, but an annuity is great for anyone who doesn't normally qualify for a life insurance policy. Okay, but this is an insurance product because your money is protected. So, but you don't have to go through the insurance process with this, so medical, all that, because you're giving them a front load of money up front, and they're understanding with that agreement they're protecting your money. So say even for example, for a $10,000 annuity, I just rolled So you can take 401ks, RAs, and roll them over into an index annuity. So instead of you losing money in that 401k, you can actually roll it over into an index annuity without penalty, okay, and without having to pay taxes. So, because I have a lot of clients, there's over $4.3 trillion sitting around in unclaimed 401ks and IRAs because people just die off and don't tell their families they have them. Okay. Or people lose their jobs or they quit and they just don't know how to roll over the money, or they don't want to touch the money because they don't want to get the taxes. Okay. So even with a 401k and a IRA, you can't touch that money till you're 59 and a half. With an index account, there is no age limit. So that's the great thing about those. That's a lot of times I'm fighting back and forth with what people say with their financial advisors, because your financial advisor is going to sell you an IRA, they're going to sell you a 401k, and that's because they're getting commission off of the sales of those products. And not to say that isn't bad to have. You want to have a 401k, maybe you want to have an IRA, but you also want to have an index account. You also want to have a savings account. You don't want to just have one avenue of retirement and thinking you'll be able to live a certain type of lifestyle, or even help your family, help your grandchildren, and not have enough money to help them. So how we help people understand how much insurance they may need is something called DIME. That's your debt, income, mortgage, and education. So that means if you died today, how much debt would you leave behind? Do you have enough of your income, what you make yearly, times 10 to leave your family 10 years of income? Do you have a mortgage, or do you want to buy a house for your family? Do you have enough money to leave that behind? And education is, usually $100,000 per kid. That's really what we call raising a kid and sending them to college, right? It's about 100,000. Parents, we know it's more than that, but average is about $100,000. So when thinking with that, right, you start thinking, okay, my debt. I tell people, take a piece of paper. We don't have time today. We can do it another day, but take it down. Write down your debt. How much do I have debt, like credit cards, loans, this? How much do I have debt if I passed away? Income, do I have 10 years of my own income? We all say we want to make 100,000 here. Do we have $1 million saved up? I had to think about this myself. Did I have $1 million saved up? No, I did not. Okay. For my mortgage, I'm buying a house currently. If I passed away tomorrow, did I have enough money to cover my mortgage? No, I didn't. Okay. In education, I have 4 kids. I accidentally had a corona baby. I didn't mean to have one of those, and I added another 100,000. So that's 400,000. So even when thinking about myself, I was already a couple $1 million into just minimum insurance need. And I probably had 1,000 there. I didn't have nothing. I had maybe 10,000. I'm like, no, I got to change this. And that's most people are, even though I was already a business owner, even though I was already on top of my things, I was not on top of thinking about what was I going to do when I passed away, or thinking about my legacy past my days, thinking about how can I avoid taxes. Okay. And so that's what most people want to do. A lot of times people are mad about politicians, mad about Donald Trump. Oh, he makes $1 billion and he only paid $3,000. Well, if I made $1 billion, I wouldn't want to give them 30% of my money either. So I'm gonna figure out how can I avoid taxes too. We do that now. I do that now as a business owner. How can I avoid paying taxes to these? What can I write off to avoid paying taxes? Okay, so that's what the wealthy is doing. But the middle class and the lower class, we're getting ate up with taxes. We're getting beat down with fees because we're not understanding how to get out of those things. So that's what we're trying to help the families, that especially our people, understand. And that's why we're bringing this information to you guys, because we're about to all be making some big money. We don't want to pass away just having that big money sitting in the bank. And y'all heard what happened to Wendy Williams, right? Wells Fargo wouldn't even give her money because they said she had dementia or something. And that can happen to you. They can take your assets, they can take your things. So you have to really understand about protecting yourself. And life insurance is one of those things you can leverage and protect yourself. And then thinking about your discretionary. This is, things I go over with families, because not only do I teach life insurance, I teach everything financial. So that's why we went over money today. We went over a couple things, just touched. I know I went through it fast, and we can have different sessions where I break each of these different things down. But I just really wanted to touch on everything. But with families, I have to go over their discretionary with them, and that's their budget. Like, what do you have that you can invest into life insurance? I have to tell them that and teach them that life insurance isn't a bill, because that's how most people think. They're like, it's just another bill. Look at these gas prices. It used to cost me what in my Tahoe, maybe $80 to fill up. Now it's like $140 to fill up. Okay, groceries. I don't get no food stamps, and I'm paying $400 a week, and that's $1,600 a month. That's $2,000 almost. I'm paying if just regular. I got all girls, but they eat like little boys. I got a cheerleader, a high schooler here. Okay, so when we're looking at inflation is at a 40-year high, when we're thinking about that, people are going to cut out unnecessary bills, and unfortunately, that's one of those bills is life insurance until somebody passes away. And that's why we got GoFundMe with over $1 billion trying to get raised for funerals. It's sad. Okay. This is when I teach families, because I'll go over, like, what are you paying on all your bills? What are you paying on different things? But we come down to entertainment. I tell people, like, if you're going to Starbucks every morning, just even to, we talked about this the other day on trading class. If you're spending $5 to $8 at Starbucks every morning, that's, it's 30 days in a month. And you get to that, that's $240 in a month. $240, you can actually invest that into an IUL, overfund the IUL for your child. Now, like for my example, for my baby boy, I started his policy, and at the age of 36, if I fund his policy the right way, he'll be a millionaire, the first millionaire like that in my family. It's gonna be me, but in an account like that, and that's he's a baby and it's 36. I'm gonna be almost 36 soon. So, I was thinking about, wow, if my mom would have started something like this when I was a baby, I'd have been a millionaire. And we're thinking about, how is white families doing this, right? How are they doing this? Is simple tools like this, but our people aren't understanding. Stop buying Starbucks, stop buying Chick-fil-A, stop buying certain things so you can't afford your life insurance or invest in it. So we're all here. We all understand investing. We all understand taking a little bit of money you have and investing it, right? So that's the same thing about life insurance. What do you have left over in your budget that you can invest into a policy? Think of it that way. Don't think of it as a bill. I'm gonna try to show you guys real quick just how much a simple policy may cost, but I can open the floor to any questions if anybody has any.
So does anybody have any questions on any of the information? This is the time to ask right now. This is a special presentation to help us out. We're all going to make a lot of money from trading, and so we need to know what to do with it and how to advance it to our next generation. So you guys ask away if you guys have any questions, okay?
Hi, Mia, this is Eddie. How you doing this evening?
Good. How you doing?
Oh, awesome. I'm a DAC as well. I have a question for you. Now, can we roll over half our TSP into a hybrid fund?
Yes, you can. I meant to say that as well. Anybody that's in the military with TSP, you can roll those over as well. As long as it's in the stage that you can roll it over, you're retired, we can roll it over.
Okay, thank you.
Mm-hmm. And that's what too, I work with a lot of military, and because when you guys actually retire, you guys are given, when you're in the service, you're given basically like a temporary policy that covers you while you're giving service to America. But once your service is over, that policy is actually over, and then you're getting services through the VA, different medical and stuff like that. But we actually don't have something. You don't have a legacy policy. They don't give you guys something that's actually going to cover your family, just your burials covered. That's it. It's not actually in whatever, money that you have that's left, it'll go to your, your family, whatever little bit that you have. But yeah, I work with a lot of militaries and guys, especially try to cover them before they get to an older age where they start developing different health problems and different things like that.
Okay, thank you.
Great question. Does anybody else have any question?
Yeah, I got a question in the chat. I'm putting a ebook in there. It's an ebook. What would billionaires do? Like what the Rockefellers do? How they back themselves up. One thing about putting money in policies is one, we all know every day we're moving closer to debt, right? But we don't like talking about it or thinking about it. But another reason why is because it's no taxes, because it's connected to a death benefit. There's no taxes involved. You don't pay taxes when you die. On that, I'm talking about on that level. I know there are, probate, different things of that nature. But if you structure yourself correctly, there is no taxes. It just keeps living and living and living and living. So we put as much money as we possibly can, and they allow us to put money in policies. It grows, it's protected, and guess what? We use it as leverage to buy real estate. We use it for other things because it's an instrument. So I just want you to think about that. It's very important that you really, 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 this is a good place that will help you defer taxes. It grows tax free. You don't have to pay money on the growth, which is beautiful. Your number one expense in life is going to be taxes. So anytime that you can figure out a way to keep more taxes for you and your family legally, you're in good shape. All right, so we took a lot of money in these policies, and then God forbid something happens to us, the next generation is straight our beneficiaries or whoever, right? But let's say you get sick and you need some super health care and stuff like that. You can tap your policies now when you're living, like she explained. So I want you guys to make sure that it would be worth it for you to take your information down and to schedule an appointment with Lonnie and have Lonnie set up some one-on-ones so they can better explain this stuff to you, and then you can maybe tell them a little bit more about more about your personal situation with these licensed professionals, okay? But please take it serious.
Yeah, especially if you guys have any old 401ks, or right now we're in the market. We see 401ks are getting pounded right now. Like I just rolled over a lady's 401k, and probably last year she maybe had like 28,000, and then we rolled it over. She only had like 17,000. So it just show you that fast how much money she lost. And she was in her 50s. She was 54, and she was trying to retire at 65. And I'm like, girl, where are you retiring with $17,000? So that's just something to think about too. So we can also just sit down and do one-on-one. So I just showing you guys real fast a index universal life. This is for a kid. This is showing if any of you have grandchildren, children with children. Okay. This is a policy for a 5-year-old, $100,000, $25 a month. Remember in the IUL, I told you that half of it's going to the premium, half of it's going into the investment account. So here you have a couple columns where you have accumulated value and death benefit. So this is just small. I just wanted to show you guys real fast. And then I'm gonna show you real quick before we get off and bring Beach on how you can grow this too. So this is just the value growing up in a simple account. If you only put $25 a month in, and you didn't overfund it or anything, then you seeing how it's growing. So when this child is going through the years at age 21, they have 22,000, and this is normal. And also the death benefit and the cash value is separate. So if you do pass away, your family gets both. So that's why here on the last column says net death benefit. You're actually seeing the accumulated value, the cash value, and the death benefit together. So this policy grows, keeps growing and growing if you never touch it. And then it's actually a point where you could pay the policy off. So I'm just going to show you guys real quick how we can fund something. So you here see at the top, you have a couple premiums. So you have a guideline single premium, that's $9,000. So you can actually pay this policy off with a $9,000 payment. What if we made that in trading, right? You could pay this whole policy off. Now your grandchild, your child doesn't have any policy payments, but now any money that you're putting into the policy is going straight into the index account. And what is that doing? That's actually growing your money. Okay. So that's just something to think about. Also, I'm going to show you real here quick how we could do that. So okay, so let's say for example, you're making money and you're like, I want to grow this to the maximum. So I'm gonna put $9,000 in it every single year. I just want it to like grow like crazy. Okay. So now you see over here, you done paid the policy off these zeros. That means that's no payments, okay, anymore. Okay. But now your value is continuing to grow without you even adding any money. So when these zeros are here, you can actually add more money, and that's going to grow your cash value. And that cash value is being invested into the stock market, and it has that index bubble. So this money will never go down. So now this money is growing, growing, and growing. And this family isn't even putting money into this account at all. And you see down here to age 65, if that's you told your child, hey, don't touch that account till you're 65, they wouldn't even have a payment for the rest of their life. And now they have $427,000. Think about if you did that for your child and you were actually putting a little bit of extra money where you had zeros, okay? And you don't have to do that. You can break it down to where you pay this monthly, that's $700 a month. You can pay the target premium, which is $250 a month. You can pay the monthly premium, which is $25. So these different levels there are going to give you different results. I'm just showing you the maximum that you can pay, and you pay off a full policy. Okay, so that's my time. I'm thank you guys. We can sit one-on-one. I'm sure we'll have another session and since we kind of broke down this information, maybe I'll be able to break down policies, show you guys a couple different type of illustrations and how they're ran, maybe actually run some real birth dates, some of you guys' real birth dates, so we can get some like live quotes or something. And thank you guys for your time. I thank you for Doc and Beach for letting me take an hour. I really appreciate and all the things I'm learning from this group too. It's really going to bring value, especially what I bring to women, because a lot of times too, a lot of, especially in the special needs community, one of the mothers that went to school with my daughter, she actually committed suicide, killed herself and her 3 babies. And the main reason was, guess what? Financial. She didn't have no, she killed herself and her babies. And if she would have had somebody to help her, somebody to tell her, hey, it's gonna be okay, maybe she would have had a different choice. So that's what we want to offer to families, especially with trading and all the different opportunities. We want to offer